Friends, can you please confirm whether I am audible and visible? In the Q&A box? Yes, thank you very much. Very good morning, friends. At the outset, let me welcome each and every one of you for the fast track webinar series BINDAS. This is batch number 4. We are in day 5 of ICAI certificate course on Indian Accounting Standard. This is exclusively for the online examination, which is scheduled this month on January 30th, Sunday. And already for the case studies on INDIAS exam, especially on these standards, 36 impairment, 38 intangible asset, 103, which is on business combination, 113 on fair value measurement, 32, which is financial instruments, and 109, which is a very important standard on financial instruments measurement. So these are the standards where maximum number of questions are designed in your examination, and minimum of 18 marks and maximum you can expect 28 to 30 marks in these 6 standards alone. So I'm doing a session, and already many have registered, and we will be closing the registration. You can get in touch with Sarpa. We'll close it maybe by today or tomorrow max. Okay. So guys, today I'm going to take you to 2 very interesting standards. One is 23, another is 33. 33 is earnings per share, and 23 is on borrowing cost. Both these standards are significant in a innotes perspective. Let me give the first aspect. Let me take you to, and once again, I want to reiterate that till last examination of certificate course on INDIAS, it was 50% pass mark. Okay. And this examination is the first exam where the pass criteria is 65. I repeat, it is 65. So meaning you need to work hard. You need to have the command on the subject. You need to have the grip on the subject. So please focus on the minute aspects in the standard, the practical aspects of the standard. So try to actually understand the standard with more simple case studies. So that will give you the grip on the subject. Let me now take you to the standard. This 33 is actually a disclosure standard, but we can call this as a denominator standard rather than as a disclosure standard. See, the earnings per share is a ratio. Please be very clear about it. Okay, which is your profit for shareholders divided by the shares, equity shares. This is fundamental. Okay, where you have additional masala is added, I'll just share with you some interesting aspect. Please look at Hindustan Unilever Limited's balance sheet, where I want to show you with respect to note number 34. Okay, please look at note number 34. This is note 34. Yes. The 33, 34. Please look at 34. This is 34. 33. I think I missed it somewhere. EPS, sorry, this is 35. Okay. Now, please look at this 35. And because I want to give you the continuing operations, discontinuing operation, all this will be there. Please look at this. You have the earnings per share, which is 31.21, 33.03. And after that, you have a diluted earnings per share. Oh, you have an EPS from continuing operation, you have an EPS from discontinuing operation. Oh, so why this disclosure is required? Okay, even though it looks like a arithmetical computation. This is an arithmetical computation. Why you have to give this? So please understand that entire NDAS is not written for accountants. It is written for the investors. It is written for the stakeholders. And you know who is the first stakeholder? The first stakeholder is the owner. And of course, others are also coming. Government is also a stakeholder. The creditors are stakeholders. So it doesn't mean that others are not there. But the first stakeholder is the owner. So naturally, what is the financial reporting should give bottom line. It should give some information to the owner. And that is why earnings per share is a very important number. EPS is a very important number. And from EPS, so many other connect you can make. EPS to MPS, EPS to DPS, and DPS to MPS. So these connect, and from there, so many other things you can multiply to get a lot of info. So this is a fundamental information which you have to provide to the stakeholders, because when they read all these numbers, big numbers, you must give them, okay, for every 10 rupees share, this is your earning. For every 100 rupees share, this is your earning. You have to give in simple terms. So EPS is the minimum, most fundamental information which you can provide, and that is nothing but two numbers: profit divided by number of shareholders, number of shares. Now this number of shares is where this entire standard is all about. Okay, this entire standard is only about the number of shares. So that is why this standard is called as a denominator standard, and this denominator has an effect. Numerator is top, denominator is bottom. Okay, this entire standard will not say, okay, what is profit? Because profit after tax, what is left over to the shareholder, I can give to government, give to creditors, give to preference shareholders. Then only it will come to the shareholders. So naturally, so that is already designed in your schedule 3 also. So what is profit available for equity shareholders? So what is the denominator? Because there will be multiple types of shares, partly paid, fully paid, and you would have announced, preference shares will be there. Whether preference shares you have to take, how will you take preference shares? Then 3, you would have announced ESOPs. If ESOPs are announced, it will not be issued, but you have committed. So in between 3 years is that, then whether ESOP shares, you have to take it in the denominator. Now, if you don't take in the denominator, EPS is more. If you take in the denominator, EPS is less. That is why the term is called diluted. Diluted. Okay. That is why it is called diluted. So diluted, why it is diluted and the background behind that will see one by one. Okay. Now 33, I just want to give an interesting fact about it, that the lunar solar cycle takes 33 years. And that is why the lunar year is approximately 354 days. That is your moon. Okay. Moon will rotate itself and also revolve around the earth. Like how the earth rotates and also revolves around the sun. Lunar, the moon also does. Solar year means 365. So there is a gap between 365 and 354, and that is your 11 days. The difference between one solar year and one lunar year, resulting from the differences in their definition, this term epoch describes the specific time difference, and this means that it takes another 33 years for the cycle to return to the original position. So this difference of 11 years, so they will rotate, it will rotate, so exact same position, if they have to come, it will take 33 years. So that is why 33 is a very, very sacrosanct number. Okay. And in Rig Veda, okay, only 33 devas are counted. 11 from earth, 11 from space, and 11 from heaven, for your information. Okay. These are all some significance about 33. Now let me take you to the first question on the share options. Okay. Now, please understand, as I have shown you here, you have the basic EPS and you have the diluted EPS. Okay. Now, basic EPS is your profit divided by the equity shares. Now, the equity shares, we will call it as VANOS, weighted average number of equity shares. Weighted average number of equity shares, VANOS. Okay. Now, or WANES, you can call it as weighted average number of equity shares, WANES. Okay, WANES. Now, why this is weighted average? Because maybe if it's a plain vanilla, you only issue equity shares at the beginning, then you keep quiet. So then you are opening equity shares, that means at 1st April, and your closing number of equity shares on 31st March, both will be same. Now, in between, if you are issued equity shares and you have converted reserves to bonus, then will you take closing or will you take opening? So how would you take it? So I will do certain arithmetic. So that is called as weighted average number of equity shares. And you divide by that, you will get EPS. And most important, I just want to take you to para number 48. Please look at para number. This is your para 48. Yes. If employee share options are given, okay, if employee share options are given. Now, normally, what is employee share option? There's a separate standard for it, 102. Okay, share-based payment. Okay. In employee share options, there is a commitment made by the company to the shareholder, to the employees, that over a period of time, maybe 1 year, 2 years, or 3 years generally. So for their loyalty with the company, they will be aptly rewarded by giving them by giving them an equity share. Now, that is an option. So employee share options, okay, that means they can opt for it. Now, why they can opt for it? It is not free. You have to pay for it. But generally, since it is allotted 3 years later, I am committing today at a fair value today, which will be reasonable, because when they contribute for the next 3 years, the price will go up. The price will go up. Today, I am expecting 3 years later what will be the price today, and I will allot at that particular fair value. Say it is 10 rupees share, I am giving at 42. But the third year, 42 will be 80 rupees. Of course, the difference between 80 and 42 is a benefit for them. So that is why people subscribe for it, people opt for it. Now, the question is EPS. Now, after you have committed, will you take that equity share in your denominator? Please remember, there is a very, very important word. I want all of you to watch that word. Employee share options are fixed or determinable terms, and non-vested equity shares are treated as options in the calculation of DEPS, diluted earnings per share, even though they may be contingent on vesting. Now, please look at this question. Okay, so look at it. Share option plans that include contingency of employees having to meet the vesting condition before options are exercised need not be considered for computing dilutive earnings per share. Is it true or false? It is actually false. Need not be considered is wrong. It should be considered. But only one aspect you need to understand about this. See, there are 2 types of share options. One, time-based share option. That means you daily come to office, sit, do your work. You don't do work, a manager will scold you. End of the month, get salary. 3 years, be loyal and get share options. That is time-based. Another is called performance-based. Okay, performance-based employee share option, you need to perform. Some criteria they will fix. Maybe in terms of number, in terms of service, in terms of revenue. Some criteria they will fix. That is called performance-based share options. Okay. So this performance-based share options are treated as contingently issuable shares because the issue is contingent upon satisfying specific condition in addition to passage of time. So I will not go by, okay, if I have committed a performance-based share options, which is 1 lakh, and every year end, I need to actually review and find out what is their performance. If their performance, maybe out of 10 employees whom I have committed, only 3 would have achieved, 7 would not have achieved. Then for 7, I need not go. So for that 3 alone, it will be converted to what is the commitment I am making. So that is on accrual basis. So they are performing. So that means I am committed to it. So that you have to include in the denominator. So denominator is very, very sensitive, guys, here. So that is why it is subject to audit also. Okay, good. So first case study is false. Second case study. As per Ind AS 33, shares issued in exchange for settlement of a liability are included in EPS calculation from what date? Now, is very interesting. I will do one question on vanos or veins. Okay, vanos or veins, whatever it is. Then I'll come to this particular question. Say during the year, I am supposed to, because it will happen generally companies who are in insolvency. I'm not able to pay. Okay, or a company which is under stress. Okay, so financial stress. So they will commit. Okay, partly I'll give equity. Partly I'll give equity. Remaining part I'll cash settle it. Okay, please understand. So there is a 40 crore liability. Out of 40 crore, 30 crore will be converted to equity. 10 crores I'll cash it. So look at 40 crores by 10 crores by cash, 30 crores only paper. Now, will you include that in your EPS? Yes, definitely, because they have become shareholders. But for when you will include? So to understand that when, I'll take you to one time weighting factor, do a calculation, then I'll come. Following is the data for which XYZ is the number of equity shares during the financial year 2021-22. Find out the number of shares as per the calculation for basic EPS. Now, this is your basic EPS, Hindustan Unilever. This is your basic EPS. Sorry. Okay. So, where is it? I think I'm missing every time. 35. This is your 35. Para 35. So 34 and 35. Okay. So 34. Look at this. So 33.85. So weighted average number of equity shares. So I am taking you to the paragraph. Okay. So the paragraph with respect to weighted average number of equity shares. Let me take you to that particular paragraph. So look at para number 21. And as per this, shares are usually included in weighted number of shares when the date of consideration is receivable, which is generally the date of the issue, for example. So A, B, C, D, E, F, G. So all this I'm going to take from para number 19 onwards. For the purpose of calculating basic EPS, the number of ordinary shares shall be weighted average outstanding during the period. And this outstanding they have explained in para number 20 and 21 with respect to various examples. Okay. That masala I will try to add one by one. Now please look at this. This is your 1st April opening balance. Okay. So what I will do. So date. Okay. So look at this, guys. So your date is actually 1st April 2021. So 1/4/2021, and this is 15th June. I am issuing equity shares. So 15th June I am issuing equity shares, and 8th November there is a conversion of preference to equity. Okay, 8th November there is conversion of preference to equity. Okay, good. And 22nd February there is buyback. 22nd February there is buyback. 31st March closing balance. So that you leave it. So what is your year end? The year end is 31/3/2022. Okay. So you need to find the number of days. So the difference between these two. Okay. So this is your number of days. Now what is your number of shares? The number of shares is 100 at 1,75,000, 50,000 minus 20,000. So this is your number of shares. So the net is 205. That is closing balance. Now will you take 205? No. You have to take the weighted average based on the time. Okay, based on the time. So what you will do is you have to multiply this. So this is your x, this is your frequency. So find the fx and divided by sum of f. Okay. So you multiply into the number of days. So then sum this. Okay. So 6,44,85,000 equity days. Okay. Now you have to divide by. Look at this. So you have to take the proportion. Okay. You have to take the proportion of this. So how will you take the proportion? By number of days. Sorry, where am I? So how will you take it? Either multiply and divide by the number of days, or straight away you can take the proportion. Okay. So 1 lakh into 365 divided by your 360. Actually 365 you must take it, because you must add that 1 everywhere. Okay. Plus 1. It will be wrong. So you take the proportion. Like what? 1 lakh into 365 divided by 365. The same you have to do it for all. Now you take the sum. So this is your weighted average. Okay. Or your 6 crore 46 lakhs 90,000, you have to divide by 365. So that also you can do. Okay. So any one method you can do. Either proportionately you can do it, or like this. So this is your weighted average number of shares. Now you come to this case study 2. I will take para number 21E. I told you there are different circumstances you have to take from what date. Okay. So we have understood with respect to new issue, conversion, buyback, all this we have. Now let us see for a liability or issued shares. Now, what is the date from where you will take for calculation of annos? Okay. So there they are giving a 21E. Ordinary shares issued in exchange for settlement of a liability are included from the settlement date. Maybe there will be a board. They will take a decision that we will do it. But what is settlement date? Even the board decides, liability still will continue in your books or accounts. And the day that particular liability is closed by issuing equity shares, that is called the settlement date. So meaning the date on which both the parties, they agree that yes, my liability is written off. There's no need to pay. So the other party has to give you a letter. Yes, it is settled. So that date is very important. Not your board resolution date, not actually the actual issue of equity shares. The settlement date is the date which has been committed by the other party. Very important. Okay. So as per the Ind AS 33, shares issued in exchange for settlement of a liability are included in the EPS calculation from the settlement date. Now let me take you to this part. Ind AS 33 requires separate disclosure of basic and diluted EPS for continuing operations. Now that is why I am showing you the Hindustan Unilever. So now look at this question. Ind AS 33 requires separate disclosure of basic EPS. This is your basic EPS. And this is your diluted EPS. This is the diluted EPS. Okay. So basic EPS, diluted EPS for your continuing operations as well as your discontinuing operations. So actually that was there somewhere in between. I missed it. Okay. Somewhere I missed it. You have to show for both continuing as well as discontinuing operation. I think I had it. Both you have to show. Okay, I'll take you to the para number 66, 68, and 69. Please look at this. So where they mention that even for discontinuing operations, you must show that. I already had it. Let me discontinue. So look at this. Discontinued operations, you have in P&L account. EPS. This is what it is. So earnings per share from continuing operations, the calculation. Oh, I was in 35 or 34 and 35. It is 35A and B. Discontinued operations, basic and diluted. Okay. So you have you need to show continuing operation, basic and diluted, and discontinued operation, basic and diluted. Now let me take you to 35 category. I think I have to take you to the respective. 25. This is 37 Continuing operation, discontinued. Separately you have to do. Okay. Now that is what is given in para number your 66, 67, 68 also. An entity shall present in the statement of P&L, basic and diluted, from continuing operations. Okay. As well as, look at this. An entity that reports the discontinued operations. If discontinued operations are there, you need to report that. Shall disclose. Shall means mandatory. Disclose the basic and diluted amount per share for the discontinued operations. Also in the statement of profits. So now answer this question. So this is continuing operations and discontinued operations. Okay. So second question is settlement date. Third is 177. What you got it. And fourth is discontinued. Now come to this part. Partly paid shares. Now partly paid shares, preference shares. Okay. So preference shares will you include it? So I have one more case study on preference shares. This is on preference shares. Okay. Now let me go very quickly. Now please look at this. I'll take you to para number A15. This is very important. This is the application. This is appendix A is an application guidance. In this, I want to take you to para A15. Look at partly paid shares. So you have various category of equity shares where 10 rupee share is only 2.5 paid. So that means 25% is paid. So out of the total number, you will only take 25%. So that is the equivalent equity. So ordinary shares are issued but not fully paid. They are considered in calculation of BEPS as a fraction of an ordinary share to the extent they were entitled to participate in dividend. If they are not entitled to participate in, that means if they are entitled to participate, they instead of 10 rupees, they are only paid 2.5. So for 10 rupees, what is the dividend? They will be only given 25% of the eligible dividend. So then you have to take out the 1 lakh shares, 20%, so 25,000. You have to include in the denominator, partly paid. Okay. So 1 lakh equity shares of 1 is, consideration is 2.5, but the paid is 1.75, received in the balance sheet. Balance 75 paisa is not paid. So that means out of 2.5, okay, please take the percentage. Out of 2.5, 1.75 is paid. So 1.75 divided by 2.5, which comes to around 70%. So 70% of 1 lakh is 70,000 shares. So that is your equivalent. So which you will include that in your denominator. Okay. So on the entire standard is only focusing on denominator. So that is why I want to take you to para number 1. Look at your para number 1. Scope. The focus of the standard is on the denominator of the EPS calculation. The entire standard. Okay. This entire standard is around 70 paras, guys. Entire 70 para, they will only focus on denominator. It is not a numerator standard. Okay. This is a denominator standard. Of course, a disclosure standard, but focus is on denominator. Good. Now come to the sixth one. For the purpose of calculating BEPS, the number of ordinary shares shall be simple average, weighted average, moving simple average, moving weighted average. So I already showed you that. Para number 19, please look at it. Okay. I already read para number 9. For the purpose of this, number of ordinary shall be weighted average. That is the VANOS. VANOS. Weighted average number of ordinary shares. So they are not considering preference. Now, if preference is there, what you should do? You have a separate paragraph in your application, appendix A. Please wait. Okay. So that is your weighted average. So not moving. So 6B. Okay. 6B. Now come to another case study. Earnings before tax. Remember, that means you have to go to government. Then only you have to take. Tax is 40. So balance 60%. So 60% of 25 lakhs is 15 lakhs. Basic EPS. Calculate basic EPS. Outstanding at the beginning 10 lakhs. Shares issued during there is 5 lakhs. Oh, so that means please understand 10 lakhs and 5 lakhs means 5 lakhs is 6 months. 10 lakhs is 12 months. So 10 lakhs has full weightage. You can take 1. 5 lakhs has only 6 months weight. So that means 50% weight. So 50% of 5 lakhs is only 2.5 lakhs. So 10 lakhs plus 2.5 lakhs is 12.5 lakhs. And your earnings after tax is 15 lakhs. So 15 lakhs by 12.5 lakhs. So that is your number of equity shares. So 15 divided by 12.5, which is 1 rupee 20 paisa. Okay. So you are able to understand how the calculation. So it is, these are 12.5 lakhs by 15 lakhs. Okay. So you get this 1 point. Now come to the eighth one. According to India AS 133, an entity shall present basic and diluted even if the amounts are negative. Now, what if loss is there? Now, I want to show you that Ashok Leyland. Look at Ashok Leyland, please. Earnings per share, 2020 it was positive. 2021 Ashok Leyland is making loss. Loss. Look at this. Loss. Profit before exceptional item. Profit after before tax is loss. Okay. Deferred tax is a gain. So loss is reduced. 313 crore loss. So then what happened? 1 rupee 7 paisa is your basic. Of course, maybe there is not much a difference between maybe share options and all already has been given. So that is a basic and diluted you have to give. Okay, even if both are same, you have to give because there is mandate. The word shall is there. Okay, so both you have to give, but here it is negative. So in which paragraph it is given? Let me take you to that particular para. So it is para number 69. Okay, look at para. An entity shall present basic and diluted even if the amounts are negative. You have to say, Buss, your money gone, Govinda, Govinda. 1 rupee gone. Okay, so that means to that extent you are, or if you are accumulated loss, to that extent your accumulated profit will come down. So whatever it is, okay, you need to mention this. That is your starting point. That is the minimum information you have to give to your stakeholders. Okay, good. So guys, there is a mega case study is there. This is actually you do this particular case study, entire standard is over because this will calculate EPS for 2 years. Okay, comparison. This will calculate diluted EPS for 2 years and also adjusted EPS, assuming the same information the previous year and then the partly paid shares are eligible for proportionate dividend. Once one type of information not eligible. If it is not eligible, what will be the VANOS? If it is eligible, what will be the VALOS? If it is eligible, your denominator will go up. If denominator goes up, your EPS will come down. Okay, please understand. So in Tamil, they used to say, Inga adicha anga valikum. So that means if you make a small change in denominator, your EPS will have an impact. If EPS there is an impact, your P ratio will have an impact. If your P ratio has an impact, your market will actually go for the volatility will be there in market. That is why this information what you publish is very, very sensitive. Okay, very sensitive. Good. Now come to borrowing cost 23. This 23 borrowing cost is very sensitive standard, guys. Okay, very sensitive. Okay, and the number 23 is I like this number. Okay, for one reason. Do you say Earth is Earth is a globe? Okay, and you mean to say Earth stands in 90 degrees? No, the Earth is tilted actually. The Earth is tilted, and in a tilted form only it actually rotates and revolves. You know what is the degree of tilt? 23 degree. The Earth axis is tilted at approximately 23 degree. And you must understand one thing that normal human sex cells have 23 chromosomes and other human cells have 46 chromosomes arranged in 23 pairs. And there was a recent Tamil film also in the same number called 23, Kutram 23, Kutram 23, meaning crime 23. Okay. So very interesting number. Okay. Now, please understand that this particular standard, core principle. Remember, guys, yesterday I did one particular standard, which is 108. The 108 is on operating segments. And operating segment standard also doesn't start with introduction or scope. It also starts with core principle. 23 is also a standard which starts with core principle. Please read core principle because 108 is a purely disclosure standard. Okay, purely disclosure because they focus on this. Now here, they say borrowing costs that are directly attributable to ACP. Please understand this word. Acquisition, construction, or production of a qualifying asset forms part of the cost of the asset. See, this is also has, you never jump to the income tax part of it. In income tax, interest There are criteria when you can charge off to P&L and eligible for a deduction, when it is not eligible for deduction. So the logic in income tax is totally different, and the logic under India is totally different. So you must actually keep your mind away, the income tax related mind away when you are reading this particular. That is why it starts with the core principle. So please be very clear with the principle. They say directly attributable to buying, acquisition of an asset, construction, production of a qualifying asset. The word qualifying is very important. From part of, as part of the cost of that asset. What do you mean by cost of the asset? That means you are capitalizing it. Other borrowing cost will be expensed. So, till what you will capitalize, after that you will expense. That is also one way of interpretation. Sometimes it doesn't mean that from one point to this point it is capitalized. In between also there will be a break in capitalization. For example, pandemic. You have shut down the factory. But okay, you have shut down. For example, let me take there is a term loan for construction of a building. Okay, now building is under construction, and pandemic lockdown is there. Construction stopped. But have the bank has given holiday for interest? No. In the pandemic, there is no interest holiday. There was only moratorium. What is moratorium? You need not pay now, you pay later. That is moratorium is different. But your interest counts ticks. That means, will you capitalize for that the lockdown period? That is a catch here. Now there they say, if you are not, you have to suspend the capitalization if there is a suspension of active development of the qualifying asset. What is the qualifying asset? Building construction. Building is being suspended. So therefore, your capitalization also will suspend. This is very important. That word qualifying asset is very important. So it doesn't mean that you start qualifying, you'll stop qualifying, after that it will revenue. No. Okay. So now here I'm going to bring very interesting calculations. Okay. I want to take you to para 3, guys. Very important. Okay. Very, very important. Okay. Say, this standard does not deal with actual cost of equity and imputed cost of equity, including preference capital, not classified as a liability. Okay. Now, understand one thing here, that you are going to capitalize interest cost. Okay. You borrow money, you capitalize it. Now, I'm starting a business startup. I don't have money. So I go to my dad. Dad, you invest money in my business. I say, I want 5 crores, 5 crores. He says, okay, I'll invest 2 crores. You start the business. Now, that is the equity I'm giving to my dad. Now, equity share, you are only paper you are giving. My dad will every day, if at all I invested 2 crores in bank, I would have got interest that this every day there will be, and the next 2 years, 3 years, you will not pay anything to your dad or to your mom. So that means there is an imputed cost of equity in it. Will that you calculate and add to the your asset cost? No. That is what they mention it here. Even there can be an actual cost of equity, because that only you invest in machinery and all those assets. Okay. So which is not classified as a liability. So it is very, very important point. Imputed cost of equity may not be eligible for capitalization. The word may not itself is not there. Not eligible. Damal does not deal. Okay. So may not be eligible. Is it true? Is it false? Actually, the word may not itself is you have to remove that word. It is not a correct word. It is not applicable. This concept of imputed cost will not come. Not applicable. So 1C. Okay, good. Come to the next question. Case study. Okay. Boilers Limited purchased from BHEL a heavy machinery on 30th September 2013 at a cash discount of 5% on invoice price of 200 lakhs. So So your invoice price is 200. Okay. So after discount, it is on this 95%, 190. Other expenses, transit insurance 2 lakhs. Transit insurance 2 lakhs. Transportation 5.5. Okay. Now these things, I will not go to 23. I will go to 16 because 16 already we have discussed. Day before yesterday we have discussed. India is 16 and India is 20. Transit insurance forms part of the cost acquisition of the asset, property, plant and equipment. Transportation 5.5. Okay. Transportation 5.5. Foundation laying expenses, that is also okay. Foundation laying expenses. So how much? 4 lakhs. Then you have installation charges. So that is also you have to. That is how much? 2.5. Now these and all I am capitalizing not because of 23. 2 lakhs to 2.5 lakhs I am capitalizing because of 16. 190 is the original cost. That is because of 16. Okay. Now only actual 23 is coming. The company had also borrowed 180 lakhs interest rate. Okay. I have borrowed 180. So now you have borrowed 180 lakhs and you have paid 190 lakhs. Of course, plus all these are you are paying from your other thing. Machinery was ready to use, ready for use. So I have to now take you to para number 5. This para number 5 says what is called qualifying asset. It takes a substantial period of time to get ready for use, for intended use or sale. Ready for use. Till it is ready for use, capitalize. Or till ready for sale. For example, you will take the, especially manufacturing, because that is why it is called ACP, production. Okay, manufacturing. So ACP. So what will you do with respect to the production related the interest cost? Production related interest cost, you have to take it to. Please look at this. Qualifying asset is an asset that is necessarily takes a substantial period of time. Now, what is the substantial period of time has not been discussed at all, has not been defined. It depends upon the asset. For certain asset, the production life cycle can be 6 months. 6 months is actually substantial period of time. Maybe you are constructing a building that will take 3 years. That is substantial. So the substantial period of time is subjective. You cannot give like schedule 2 useful life. They give some period. Now that is an indicative. Ashok Leyland says schedule 2 as well as the useful life both they give. Certain assets they get lesser than the schedule 2 they take, greater than schedule 2 they take. So these are all you have to apply mind. You cannot go by the old methods. Business first, guys. Business first. Okay. So therefore, 180 lakhs. So you buy on 30th September, ready for use. The word is called ready for use. Till that you have to capitalize. Till that you have to capitalize. That is actually given here in para number commencement. Entity shall begin commencement. Okay. As part of the qualifying asset, when it incurs expenditure, it incurs borrowing costs, it undertakes activities that are necessary to prepare the asset for its intended use. Now here, how long? From 30th September, that means 1st October onwards till 31st March, October, November, December, January, February, March. So 6 months. 6 months interest rate 16%. So on this 16% or 6 months by 12. So 14.4. So your borrowing cost is 14.4. Okay. So what is your borrowing cost? Oh, he doesn't ask borrowing cost. He's asking cost of acquisition. By applying principles of 23, which says the qualifying as an asset necessary to take substantial period of time to get ready for intended use. So let me add all this. From 190 is your cost, because that is your cost of acquisition. COA 280. This is your cost. 218.4. So because the question is cost of acquisition, sometimes the multiple choice question, they'll give 218, they'll give 14.4, they may give 14, and they may give 190 also. 4 options. So you have to go by the question. Question is cost of acquisitions. Okay. Good. Now, I'll take you to another paragraph number 14. Now, this is a very interesting paragraph because it has been substituted only 2 years back. Okay, on 31st March 2019. Okay. Now, you borrow from various sources at different interest rate, and then you invest in one particular project or one machine. Then what is the borrowing cost? Will you identify each one or how will you do it? Because you borrow from three sources at three interest rates, and all the three sources invest in one particular asset. Then how will you calculate? Will you calculate the individually borrowing cost and then add, or on that portion only you are actually investing in that cost? Then you have to go by some average method. So which will you go by FIFO? No, weighted average only. So to the extent that an entity borrows funds generally and uses them for the purpose of qualifying, entity shall determine the amount of borrowing cost eligible for capitalization by applying a cap rate. The cap rate you have to calculate. The cap rate is the weighted average rate to all the borrowing of the entity that are outstanding. Or an entity shall exclude this from this calculation borrowing cost applicable to borrowings made specifically for the purpose of obtaining qualifying asset. There are 5 loans, 2 loans are exclusive for that. 3 loan you have taken, out of that 40% only you have used. When you are saying 40%, then find the AB rate, that's called absorption rate or cap rate, okay, capitalization rate. The cap rate you have to calculate and you have to apply, you have to take the weighted average. So how do you calculate that weighted average? Let me do a small question. A Limited building a bridge costing 10 crores. 6 crores is from 8% loan. 4 crores is from a pool of loans. Okay. Actually, 4 crores is not 4 crores. Maybe some big amount. From the 35% is contributed at 10%. 65% is contributed as 12%. So let me calculate this. So what is your loan? Your loan is 10 crores. 6 crores is at 8%. So 6 at 8%. Then you have 4 crores. 35% of 4 crores at so you have 35% of 4 crores, which is 1.4, and 65% of 4 crores. You have 65% of 4 crores. So this is your loan amount. So which is your total is actually. So this is your. I will call it as F. This is your X. Okay. Frequency. And what is your interest rate? 10% and 12%. 10% and 12%. Now you have to find your FX. So what is your FX? F interest, like your statistics. Okay. So 6 crores into 8%. And if at all they have given the time, 6 months, 8 months, 9 months, 4 months, 3.5 months, you have to do that also. Because since nothing is mentioned about the time, I'm taking it as full year. Okay. That's for simple understanding. If the time is also given, I have to proportionately take the, because this is the interest amount. 0.48 crore is interest. 0.48 crore is for 12 months. If the time is less, you have to proportionately take that. So on this, you have to take 10%. On this, you have to take 12%. So your total interest is actually 0.93. So on 93, you have to sum of FX divided by sum of F. So this is your interest rate. So 9.32. So that is your interest. Okay. So is it 8%? No. Is it 10? No. Is it 12? No. 9.32. So 3V. Okay. Now come to as per India is 23. Borrowing costs are always capitalized when they are directly attributable to the ACP. Now that is actually given to you in your para number 8. Please look at para number 8. That is the recognition. The entity shall capitalize borrowing costs that are directly attributable to the acquisition, purchase, construction, or production of a qualifying asset. Okay. It is equally applicable for your finished goods also. Okay. Once it is finished. After that, it will become inventory. Once it becomes inventory, it is ready for sale. Once it is ready for sale, you may sell it next day, you may sell it next week, you may sell it next month, you may sell it 6 months later. Interest applicable for the finished goods, you have to charge off to expenses. Until it is in production, you have to treat it as part of the inventory. So that is why I want to take you to Ind AS 2 also. Please look at Ind AS 2. There they will mention about Ind AS 23 with respect to the interest part. Okay. Now, let me take you to the borrowing cost. Look at this, 17. See, in your inventory cost I'll compare all cost of purchase, conversion, and bringing the inventory to the present location. Here, cost of purchase, cost of conversion. In cost of conversion, other cost, abnormal cost, storage, etc., borrowing cost. Borrowing cost identifies limited circumstances where borrowing costs are included till it is ready for use, not ready for sale. That is very important. That is very, very important. Okay. And these are all you need to. So from 2, there is a bridge to 23. From there, they say go to 23. So they have not discussed that here. They said borrowing cost you have to include. Okay. Very interesting part. So as per 23, borrowing costs are always capitalized. So I will take you to para number. An entity shall capitalize borrowing cost attributable to acquisition, purchase of asset, construction of asset, production of a qualifying asset. So that qualifying asset doesn't mean only non-current asset. It also means current asset. Okay. So look at qualifying asset. The definition of qualifying asset is an asset. They don't say current or non-current. Okay. So an entity shall recognize other borrowing costs as an expense in the period in which it incurs. It is repeat. It is repeat given in your other borrowing cost recognized as an expense. Core principle is repeated. Always core principles will be repeated minimum one more time in the standard. Please understand that. Okay. So that is very important. Okay. So therefore, an entity shall capitalize as part of the cost of the asset. Okay. So borrowing costs are always capitalized. This word always capitalized is wrong. It is only shall capitalize. But anyhow, the meaning is capitalized, so we can take it as true. Okay. Meaning only it is. So actually it should be shall. Shall means mandatory you must. Okay. This is an English meaning, always capitalized. So that is why there is a difference between an accountancy teacher and English teacher. English teacher will say always, an accountancy teacher will say, okay, shall. This is another. So this question is the bridge between 23 and 2. Now, I am going to bridge another standard between 23 and 36. Now, 23 and 36. So, what I will do, I will take you to 36 also. I am going to discuss 36 in my 20th and 21st sessions. Very important. Okay, don't miss that. And very, very big standard. 58 pages. Okay, and look at the number of paras. Okay, so you have up to 134 paras and 3 appendices. It's very big paras, very big standard. Okay. Now here there is a mention about borrowing cost. Okay. Or in impairment. Now please look at this. The expected ultimate carrying amount of a qualifying asset. Okay. I'll take you to first para number 16 here. Okay. Look at para 16. Excess of the carrying amount of the qualifying account over recoverable amount. See, sometimes what will happen? Your non-current assets, say your machinery you bought for 10 crores and your interest is 1.5 crores. So 10 plus 1.5 is 11.5. But the recoverable amount is not 11.5. Okay, recoverable amount is actually 9 crores. Then what to do? Okay, when the carrying amount or the ultimate cost of the qualifying asset, okay, exceeds its, what is the ultimate cost means what you add, okay, the cost of the asset. Carrying amount is after depreciation. The carrying amount or the cost of the qualifying asset exceeds the recoverable amount or net realizable value. Now, why net realizable value? See, this fair value is like your Mahavishnu. What is Mahavishnu? Mahavishnu has taken 10 avatars. Dasavatha. Similarly, fair value will take different avatar in that standard. In India AS 2, fair value is called NRV. In India AS 36, it is called recoverable amount. Recoverable amount. In India AS 16, it is actually called your revaluation. Okay, revalued amount. India AS 113, it is called fair value. So fair value is fair value in different context. So it is like Mahavishnu only. Everywhere it is same God only. You pray God, and God will actually give you all whatever you ask for. But avatar is different, and circumstances is different. For the circumstances, Machavataram. Okay, so you go to Nagalapuram. What is the first avatar of Mahavishnu? Nagalapuram is in Andhra Pradesh. So the first avatar, Machavasaram, will be there. So 3 days, the entire sunlight will fall. First day on the legs, second day on the nabi, third day on the serum, okay, on the head. So that is also Mahavishnu only. Lord Venkateswara is also Mahavishnu only. So fair value will take different avatars. Okay, now look at this. So your book value is 11.5. Recoverable amount is 9. This word recoverable amount is, you have to go to 36. 36 only says, impairment says, you have to apply the impairment testing and arrive at the recoverable amount. Recoverable amount, you have a model there. So there again, fair value will say, and again you have to go by discounting, valuation and all you have to use. So recoverable amount is 9 crores. Book value is 11.5. So what is the difference? 2.5. Now what you have to do? 2.5. Carrying amount will be written down or written off in circumstances with the requirement of other standards. Okay. Now look at this. The recoverable amount is 9.95 crores. The ultimate carrying cost or ultimate cost. Okay. Actually, the word ultimate carrying cost is wrong. It is called as ultimate cost or carrying amount. The question itself is wrong. The expected ultimate cost or carrying amount is 10 crores. Okay. The recoverable amount is 9.95 crores. Then what to do? Borrowing cost included is 1 crore in accordance with this. Now what should you do? Actually, it is 9 crores only. 1 crore you have added. So 9 plus 1, it has become 10. But it has come down to 9.95. Now what will you do? As per India AS 23, you capitalize 1. So it has gone to 10. As per 36, you have to compare the 10 with the recoverable amount. They say the balance, the difference of 10 and 9.95, 5 lakhs is the impairment loss. You have to debit to P&L account. So the amount to be written off on account of impairment is 5 lakhs, not 1 crore, being the borrowing cost. Borrowing cost, you cannot do anything. Okay. That as per the prescription, you have to capitalize it because it has already been capitalized as per 23. This means that in accordance with 23, it has been done. Matter over, settled. 95 lakhs. Where is 95 lakhs? Okay, it has nothing to do with it. Nota means it's not applicable. So 5 lakhs. So 5A. Okay, good. Now come to next question. According to India AS 23, which one of the following statement about capitalization as part of the cost of qualifying asset is true? True. Okay. Now let us go on by that. Capitalization will continue until the asset is brought to use. Wrong. Why? Because para number 20 you have to see. Look at para 20. Look at para 20. The entity shall suspend the capitalization when there is active development is suspended. So therefore, this statement will continue till it is brought to use. This is wrong. That is why I gave the example of lockdown. A is wrong. Capitalization always comes once the expenditure is incurred. Wrong. Because there are 3 conditions you have to satisfy. What are those 3? Once you incur the borrowing cost. Okay, please understand. Once the expenditure is incurred, no, you have to incur the borrowing cost. Okay. Incur the expenditure for the asset, incur the borrowing cost, and undertake activities. Now, what do you mean by incur the expenditure for the asset? Sometimes you will take the loan. Interest will count. But the money will be there in bank account. You will not pay that money for the machinery. That is why incur expenditure for the asset. You borrow, keep it in my bank, pay interest. Will you capitalize it? No. Where will you capitalize? This money you have to incur expenditure for the asset. That is the point. So common says once the expenditure is incurred, no. you have to incur the expenditure and the borrowing cost both. So therefore, it is partly correct. Okay, not only you for example, they will give that interest holiday sometimes. Interest holiday, will you capitalize or you cannot capitalize? So B is not fully correct. Capitalization will commence as soon as interest on relevant borrowing is being incurred. No, actually B and C both should happen. Expenditure should be incurred and also borrowing costs. Look at this. Therefore, when the entity meets all of the following conditions, so any one is not true. B and C both are true. Okay. If the funds are borrowed, generally capitalization rate is based on the weighted average of the borrowing cost. So D is true. C as a single statement is not true. B as a single statement is not true. A is false. A as a single statement is true. If the borrowed funds are general, capitalization rate is based on weighted average. And that is given in para number 14. Please look at this. If it is found general, then the entity shall determine the amount of borrowing cost using the cap rate. Okay. So your answer is D. Guys, it was a pleasure discussing with all of you for the past 5 days. Can I have your feedback today, please? Maybe I'll just take maximum 5 days and you can raise your hand, or I will identify a few of our participants. So let me ask Mr. Rajkumar Kotari. Mr. Rajkumar Kotari, I have unmuted you. I will also request R. Sangeeta to unmute yourself, and I will also request Santosh Sahu to unmute yourself, please. And let me also request Mr. Madan Mohan, Praveen Kumar Jain. I will unmute, please. Praveen Kumar Jain, and I will also unmute Mr. Ghosh, Mr. Aninda Ghosh. I will unmute, please. He is CFO of JSW. Yes, Mr. Praveen Kumar.
Sir, I'm Santosh here.
Yes, please go ahead, Santosh.
Good morning, all of you. It was very nice session, sir. For last 5 days, you have taken a great picture of all the India SS. Almost all standards are covered. All important standards are covered. Basically, I was just preparing for some interviews and to have some knowledge of India SS in very short time. Your sessions has taken me the synopsis of what exactly the standards, how to go through the standards in very immediately, and basic knowledge of at least that it has given. Sir, we'll request to similar standards can be similarly we can take some like another 5 days classes for some other days if you are
I'm already doing that 2 day session. You can be part of that session, please. Thank you very much, Mr. Santosh. Can you briefly introduce yourself?
I am basically a chartered accountant, means working in MNC company in Pune.
What is the name of your company?
Greens Power Equipment India Private Limited, sir.
Okay, good. Our best wishes to you, Santosh.
Thank you, sir.
We'll now hear from Mr. Praveen. Good morning, Praveen.
Yes, sir. Good morning, sir. I am from CA Praveen Kumar Jain from Delhi. I am also insolvency professional and registered valuer. Right, sir? And I also attended your factor course and valuation course also, and very much impressive. And today I only joined for this batch, and which is also very much beneficial to participants for their exam and the practice purposes. Thank you, sir.
Thank you, Praveen Jain. Thank you, Praveen. And let us hear from Mr. Ghosh. Very good morning, Mr. Aninda Ghosh. You can speak now. Mr. Ghosh, you are on, you can hope you are not connected with any external gadgets. You can speak. Very good morning.
Very good morning, sir. Sir, I was asking that insurance claim, if we receive insurance claim against a damaged plant, that is, so can we treat it as a revenue?
No, revenue, it is only based on a contract and on certain performance
because-
obligations you satisfy, then only the revenue will come. So maybe you can write down the facts separately in an email. I have to understand the facts more.
Should it be reduced from the capital block or gross block, or should it be charged to revenue? Insurance claim received.
Insurance claim is actually, for example, your machinery is 10 crore because of maybe certain damage or certain fire or mishap. It has, you have got a claim for 2 crores. That means that is a classic example for your impairment. Okay, so 8 crore you have to treat it as a special loss. So here, what is the particular event, and based on that event, fire loss or whatever loss, you have to knock that particular asset to the value, and whatever you are realizing, and you can retire that from your active use also, because you cannot depreciate it also, and that is your scrap value or whatever the insurance value what you realize. So that is how you have to go for it. It cannot be treated as a revenue because there is no contract whether for goods or for service.
Sir, in the India's book by Dolphy D'Souza, so he is explaining that it should be treated as a revenue because he is saying that it is a different event altogether. So
It all depends on the contract, Ji. So what is the what is the kind of event? Why you have what kind of insurance you have actually entered with the, for example, there is a difference between insurance claim of asset and insurance claim with respect to loss of profit. So what type of insurance you have not mentioned it. So it all depends upon the contract what you have with the insurance and the clauses with them. So I will recommend Ghoshji to kindly write to me separately what is the facts of that particular circumstances, so that whether it can be used or not depends only upon the circumstances. Generally speaking, if it is a product related insurance, it may not be. Thank you, Ghosh. Thank you, Ghosh Bhai. Can I request you to kindly share your feedback about the session, please?
it's excellent, sir.
And anything else you wish to share? You are welcome, sir. You are welcome. Thank you very much. And maybe one more person. Let us hear from our Sampath Kumarji. Very good morning, sir, for your closing remarks. And we have Sangeeta. Let us hear from Sangeeta. Maybe I'll just unmute Sangeeta. Can you speak, Sangeeta? Yes, good morning, Sangeeta. You can speak now. You can unmute yourself and you can speak. Good morning. Or maybe she is not able to connect. I don't know. Yes, maybe I'll request Sampath Kumarji to kindly give the closing remarks.
Good morning, Dr. Raju and my dear friends. These 5 days treat with respect to various important standards as mentioned by our friends. Very minute and detailed coverage. Frankly, the words cannot express the feeling of gratitude, the commitment and passion with which Gopalakrishna Raju and his team made the background work to provide this type of knowledge, which is an exam-oriented one. The two standards of today, 33, which is a disclosure standard, which is a denominator standard. There are various types, and it is very, very important to highlight about the other standard also, which is with respect to our borrowing cost, with minute aspects of calculation, implications, and the manner of interpretation. In all the questions, friends, you can note down why the four possibilities are to be considered before jumping into. The tendency is, it is immediately this is the answer. No, wait. Go through the second, third, fourth operation. Eliminate the three before concluding what it is. All the very best to each of my friends for the ensuing exams and their practice. Thank you, Dr. Raju, for this wonderful presentation. I am very particularly eager to attend this particular pinnacle course on today's scheduled for 21st and 22nd. Thank you, Dr. Raju, and my dear friends.
Thank you, sir.